Hello everyone. Now we have reached our session 63 video. The topic is real estate investing versus stock market investing. So here, as you already know much about stocks or what is stock market investing, and you have been a subscriber to my channel and you have hopefully gone through all the videos I have uploaded till now, which are the 62 videos. So I'm pretty sure that you already would be knowing very much or almost everything about stock market investing, or in that case value investing. But here in this video I will be concentrating more on real estate investing, because anyhow we are covering many of the investment topics in the channel, not only just about stocks, but we have discussed about REITs, we have discussed something about mutual funds. So as always we will be going deep into the topic real estate investing. So before getting into the session, I would like to give some credits to a book which I read, which had really motivated me to do this video. So the book name is Real Rich, Getting Real About Real Estate. This book is written by data collected mainly from Mr. Atul Goel. So if you are in Maharashtra, you already know Goel Ganga Group. So Mr. Atul Goel is owning this Goel Ganga Group. So he has given a lot of insights in the book. So all the compilations is done in the book, and if you have an opportunity to read the book, I would like to suggest you to read the book. Anyhow, many of the major aspects which is told in the book is been absorbed in this video. As always, I always try to value add to my viewers by collecting data, researching, analyzing, and especially extracting the data from great books like this. So what is real estate? As per Investopedia, real estate is the land and any permanent structure like a house or improvements attached to the land, whether natural or homemade. So unlike other asset bases like stocks, bonds, or other investments, you can physically see this investment. That's the difference. So that's the name real estate. So it's real in nature. You can physically see it. You can physically feel it. You can go and stay in that. You can have discussions in that building. So it's real in nature. Of course, you can show off the building and you can tell that you are having a real asset. Or so many times the old guys especially, or the old generation especially, is big fans of real estate, because they believe in physical assets or things which they can really feel or see. So that's why stocks, bonds, or other investments which are not in physical nature but I would say digital form is of least importance to them, because of the difference in thought process. Also, there is a human being tendency that a home gives a comfort of living, so it's a physical asset. So a house or a flat, all these things are real estate. So this gives them a real comfort, unlike the uncertainty or things which they think is risky as far as the stocks are concerned. So that is why they are more comfortable, or they find their comfort more in real estate than stocks, though they yield very low yield compared to stocks. Also, one thing which drives the real estate is that the population is always increasing, but the land or the earth is the same. So there will be always an increase in demand for the land or property. So this is what is driving the real estate market. So why I am covering this real estate is because we always talk about diversification. You have my video of diversification in my earlier sessions. So diversification is not just across the single asset class. Like stocks, you have mid cap, large cap, small cap, or multi cap, or international funds, all those things. These are things which will help you diversify across that asset class, which is stock market or equity. But in addition to this, there are a lot of investments which you may try or think of diversification if it really fetches you returns. So this, regarding the real returns of this asset class, we will be definitely reviewing in the session. So you can do your due diligence and opt if you choose to go with a real estate asset as well. Also in this session, I will be discussing briefly on what all ways by which you can invest in a property, whether it is commercial or residential, and what are the means by which you can even go with digitalized solutions like crowdfunding, REITs, etc., which are also ways by which you can invest in properties without much hassle. Real estate mainly is of 5 types: residential, commercial, industrial, raw land, and special use. So all these words, the word meaning itself explains you what are the differences in all the 5 assets as far as the real estates are concerned. Obviously, the first way of investing in a real estate is direct investment. Like you physically go see the property, whether it is home, whether it is a land, whether it is a commercial property, whatever it is. So you directly deal with the builder and you buy the property, and you give the money to the builder, and you make that property your own. So that is direct real estate investing. So that is one way of buying the property. We will definitely detail much about that and what all things you should take care while buying a real estate property. For that, I would also like you to know ways by which you can invest in real estate, not on a physical basis but on a digitalized solution basis, like stocks. In the sense, the first way of investing in real estate or commercial properties that you already know and have done the video on REITs, Real Estate Investment Trust. So if you have not seen that, I strongly recommend you to go see my video number 47, in which I am clearly mentioning the difference or what is a REIT and the difference between a REIT and a real estate. So first was direct real estate investing. Second is REIT. So REIT, already you know, the property in which it is invested, 90% of the rental yield is given to you as dividend, and there are various taxation policies. There is some taxation rebate also in REITs. So everything, if you want, you can already watch my video 47. But in a REIT, the thing is that you will be investing in the company which is investing in the various properties, not directly in the property. So the company will be managing the assets, and company will be taking the commission, and rest amount as a dividend will be given to you. Third way of investing or participating in real estate investing is by directly investing in stocks of real estate or builders, say Shobha, Purvankara, DLF, etc. And the fourth way of investing in real estate, especially in commercial or warehousing, is through crowdfunding. So this is the latest one. So this one is popular worldwide since 2012 actually. These real estate crowdfunding platforms are utilized for raising both equity and debt for real estates. So these real estate crowdfunding platforms are mainly used for raising both equity or debt for real estate deals, though equity is the most common one. Here, unlike a REIT, wherein you are investing in a company which is investing in the various properties, in crowdfunding, we are directly investing in a particular property which is existing in particular area, say Mumbai, Pune, or Bangalore, or Chennai, wherever it is, say a mall or a floor in a huge building or whatever it may be. So that property is bought by this crowdfunding platform and it is registered onto your name. So for this, they use special purpose vehicles. So what they do, maximum they can go with 200 investors, and a minimum cutoff price is 25 lakhs. Earlier it used to be lower. So this 25 lakhs, what they do, they collect from this much investors. Maximum number of investors, as I told, is 200 as per the rule. And this fund, which is raised on a property using a special purpose vehicle, they form a private limited company. So this private limited company ownership is by this, say, 200 investors who has invested 25 lakhs each. And this private limited company will be registered as the owner to that property. So in crowdfunding, many of the people go with pre-leased property. So they don't go with a under construction property. So the risk of rental yield is also mitigated there. So probably from 21 to 1.5 months after agreement, you start getting the rental yield. So normally they give 7 to 8% rental yield, though they tell 9 to 10%. Once you cut off the 1% management fees on each rental yield, you will be effectively getting 7 to 8% only. And also they give a property appreciation of around 5 to 6% every year, because what they claim is that they buy the property at a lower rate, many times below the ready reckoner rate. So they do pay the stamp duty for that, but they can definitely buy the property at least below 10% of ready reckoner rate as per the law. And why they claim that it is at a reduced price, and why they claim that they are able to buy the property as a reduced price, is because it's a large funding which is being collected by this platform. So such a large funding will not or may not be able to be arranged by the seller from a single person. So that advantage they are taking, and they are asking for a reduced price, which the seller is also happily agreeing to pay. So this reduced price easily helps for a increase in property appreciation as soon as the property is bought. In addition to that, this 5 to 6% property appreciation, which is an approximation, it can vary based on the various global conditions as well. But on an average, if you take this and add this to 7%, you can get a 12 to 13% overall appreciation year on year. So this is also fairly good enough compared to a rate wherein you will get 6.5 to 7%, and the stock appreciation or the particular appreciation of that ticker, whether it is Embassy, Rate, Brookfield or Mindspace, which are the three listed rates in India, will not be that much because they are almost flat if you see the past performance also. Though the NAV, which is the net asset value of the property owned by the REITs, may be higher, always in Indian market it trades at a 15 to 20% discount to the NAV. So this will not happen in crowd-funded platform because this is a real asset which is already fully constructed and functional. Unlike a REIT wherein 80% only is invested in ready to move properties and 20% can be invested in under construction properties, which actually will not fetch you any immediate rental yields. Now getting back to our original topic, direct real estate investment. So there are two types of owning a real estate. One is under construction and other one is ready to move or ready possession. So on my screen you can see a comparison of under construction and ready to move properties. I request you to go through that, give a minute and go through the table and then proceed. So from the table it is very clear that under construction property really gives you appreciation, capital appreciation, as far as the increase in valuation is concerned, because ready to move already have mitigated all the risk and directly you are getting into the property means the builder will definitely ask for more. But in a under construction property, say 2-3 years delay in possession because the construction has just started, has a risk that the builder can go bankrupt, or maybe there is a delay in construction due to unavailability of materials due to some global pandemic or any uncertainty in situations, or say there is any new regulations coming in, or say there is some cost overrun, etc., etc. So that risk is converted into a reduced price, and this has to be actually evaluated by us doing a due diligence, and this will ensure that you will get an appreciation on the property which is bought under construction. So if you see a builder and a buyer, so builder takes all the tension. They have got lot of approvals from various authorities. So politically also there are lot of issues. I will not get into that. So if you see, there are n number of approvals to be taken, clearances to be taken, environmental clearance, land clearance, lot of documentations, lot of payments. So all these things has to be undergone by a builder to set up a property and to build a property and to clear the property and hand over that property to the buyer. So some people tell that I am buying the home just not for an investment. I don't consider it as an investment at all because it's my first home. So I want a comfort in that. I am ready to pay a premium for that. But if you ask me, I'm a pure investor. So yes, home is required, but also you have to take care that, as I mentioned in my earlier video on how to get rich, how to get real rich, you should not spend on a depreciating asset. So you should ensure that you are buying a asset and not a liability. So if you have to assure that you are buying an asset and that too you are going to live in that and you are not going to get a rental yield, only way by which you can make it an asset is buying it at a depreciated price or undervalued price. And once the property is constructed and the valuation of the areas goes up and also the property and the flat valuations go up, it will fetch you good returns. So it is very clear, at least the people in my group should understand that you should buy a property under construction, and a good one. You should do all your clearances, but also you should like, your family should like the layout and everything. But once you buy it, you have to ensure that you will get a good appreciation on the property, and hence you don't waste your hard-earned money in such a asset which may depreciate your asset value going forward. So valuation of the property is very much important before getting into that. So wealth creation in a real estate asset happens by a streamlined, harmonious cooperation between three entities: a builder, a buyer, and a bank. So builder, as you know, he builds the property, clearing all the documents, converting the land to a livable area and making it good to live. And buyer is like persons like me who buy that asset or buy that flat or property and go there for a living, or say give it out for a rent. And third one is a bank. So as I told, you should not use your money to buy the asset. You should definitely use others' money, which is the bank's money. So take it on a interest, a good interest, whichever is possible, and this interest will be given to the bank, and you lend the money from the bank, and this will be given to the builder to buy the property. The interest which you are giving to the bank, which is your cost of capital, this you have to ensure that the return on capital is exceeding this cost of capital, because the return on capital is nothing but the property appreciation going forward. So this will give you returns, and this return should actually bridge the interest which you are paying to the bank, which is basically others' money. If it is not happening, you have to rethink about your investment. So if you talk about a buyer, there are a lot of concerns by the buyer: the building quality, the if the property is legal, if there will be a good formation of a society once the society is handed over or the building is handed over, will there be a property appreciation going forward, will there be timely handover of the property. So if there is no timely handover, you are paying rent to the current owner, so you are a tenant there, so till the moment you are getting your new flat, you are paying the rent, so that is a loss of capital for you. So the later you get the property, the more you lose on the rent. So another concern is, will the crowd in the property be good? Could you gel with them? Are they of your type? And another thing is that whatever amenities or fittings the builder had promised you, are they able to give that? Also, if the interest rate, as RBI keeps on increasing interest rate based on the inflationary issues, so this also increases the EMI and also your burden of interest payment to the bank. So if you think from the builder perspective, we have to pay the builder on time so that builder delivers the property on time. So this is also to be ensured, because builder may not have his own funding. Yes, definitely he'll have some funding, but rest has to come from the buyers. That's how the business works. So we have to ensure that as a buyer we are paying the builder on time so that the work is not getting hampered. So if you see, there is entities like RERA, which now ensures that builder doesn't divert the money which is to be utilized or which is collected from the buyers of the flat is utilized only for this particular property only, and it is not diverted to any other assets. Earlier it used to be a problem, but now RERA ensures the same. And another thing is that the buyer has to pay the builder on time. So RERA doesn't have any provisions as of now, but that also will ensure that the builder does the property handover on a timely manner. So as I already told you about the under construction property, so there is something called cost of indecision. It is like the cost a buyer has to pay on a later date because of his indecision on a previous date. For an example, so there is a property, say in Pune, say in an area 5 years back, the property used to cost, say, a 750 carpet area 2 BHK used to cost, say, 40 lakhs. Then at that time, say I am the buyer, so I took a decision that it is too costly, maybe I will buy it on a later date. So after 5 years, now I am paying, say, 65 lakhs for the same property, which I was getting at 42 lakhs at that time, so in the same area. So this is like, this is the cost of indecision. So at that time, if I had decided to buy that property, I would have saved this much amount. So a delayed decision is a cost for you. So to have a higher return on investment, which is ROI, we have to keep COI, cost of indecision, low. So as always, I would tell that, or I would urge you as a real estate buyer to make use of loan, which is others' money, and get it at a good interest rate based on your CIBIL score, etc. And if you have a joint account, you will get further more reduction in the interest rate. I would urge you to utilize that and go for the highest loan, so that you utilize the bank's lending provision and make your property, or make the property your own, and accordingly pay back whenever you get a good returns from your stocks, from your bonus, or from your dividends. All these things you utilize to repay the loan amount. But definitely don't use your own money, because it's a cost of capital for you. So if you are getting 15% return from stock market, and if you are getting the bank loan at 9%, so 9 minus 15 is your delta which you are getting from the stock market. So don't liquidate that stocks, but lend it from the bank and put it on EMI and try to repay the loans. So that is as far as a stock market investment or stock market investor is concerned. Others may not be able to match that cost of capital, which is 9% interest. We will not get it in FD, so there is no point in putting the amount in FD and paying the EMI. So it is better to liquidate the FD. So technically speaking, loan is nothing but buying money from an institution, then repaying the money in an orderly fashion to repay the debt and making the property our own. So it's like buying money and paying back the money. So loans are like bridges. So they try to bridge the gap between the initial investment which you have, and the property price. So this difference is bridged by the loan. You should always know that the value of money keeps on depreciating based on the inflation. So if you have an EMI, home loan EMI of say 35,000 or 45,000 monthly, currently you may take a hit, or you will have to adjust, or you have to reduce all other expenses to fit into that EMI. But going forward, your salary would increase, your value of money also will decrease. So basically this 35 or 45,000 becomes actually sort of peanuts for you. So that's why the earlier you buy it and earlier you take an EMI, it's more advantageous for you. So from the cost of indecision point of view, time is money. So if you lose on time, your cost of indecision increases, and your return on investment also reduces. As I mentioned earlier, many times builder launches the building, so they give lot of discounts. Some new builders come to a particular location, say Gujarat builder comes to Pune for a construction. They are to prove in the location, so they may offer some discounts just to ensure that they get proper booking. And once it is done, and once they exhibit that they are a good builder by the quality of assets they create or the buildings they build, so then they go for premium. So such new builders, if they are proven in another state and they are coming here, it's the best time you invest or you buy such assets. Also, buy such properties wherein the builder has thought of everything as far as the amenities, the layout, or the area, or the facilities which is given to you is being taken care of, so that on a later date you don't have to break your head for mitigating the issues which is coming into that property. Also, initially you need not have to buy a 1 crore property or a 2 crore property. Initially you can start with a 50 lakh property as well, or even 60 lakh property as well, and you live there. You increase and as the location improves, the access or the facilities in that location also improves, the property also appreciates, then you can sell off that asset or that property and move into another good asset. Also, it is to be noted that if it's a low ticket item like 60 lakhs, it is very easy for you to liquidate that asset or sell it to a third party, because the higher the value or the larger the property is, it is illiquid and there will be less buyers and you will have to compromise on your price. So that is the advantage of going with a smaller property and a lower value property, so that you get an appreciation as well and you get a good buyer at a good rate as well. So again, I would like to relate that to the stock price of MRF. So MRF current market price is too high that not everyone can buy a single stock immediately. So small participants thinks whether I should buy this stock ticker or not. So this cuts off lot of liquidity in that product, lots of liquidity in that stock, and also you can see that the fluctuation or volatility in the stock is very low. So this is a decision taken by the promoter as well, that they don't want any small investors to trade in their stocks. So they have not knowingly uh, split the stock, and the stock price has gone so high that high value investors only invest in that, and much of the trading in the MRF is also reduced. The trading volume is reduced so that the stock doesn't have any much of an impact in a day-to-day basis as far as the trading or the volatility is concerned. Similarly, the property, if it is smaller in piece, it will be attracted by many investors, and if it is larger or costlier, you will get less buyers. You live there for say 3-4 years, and if you get a good appreciation for the property and the mob in the area also becomes good, so then you can give that flat for rent, and you can take loan from bank and buy another property and move on to that property, and you have a rental yield from this property, and this will help pay the EMI for the second property as well. So this is how you create real estate assets with a good cash flow. Also, there is another perspective for the flat which you are buying, because you need to take care of your family needs as well. So your family is living with you in that flat. It is not just an investment. So also their happiness is important. So some things you may have to compromise as far as the valuations of the flat is concerned if you really want a good one. But I would say you should keep all these aspects in mind so that you get a best deal. So real estate, as you know, on a longer term helps beat inflation for sure. And on a longer term, you have to ensure that it not only beats inflation but fetches you good returns, so that that property is considered as an asset, not a liability. So as I told, a new builder and a developing area, all these things are uh, and an under construction property, all these things are factors which will help you get the property at a lower rate, which will give you a valuation or property appreciation going forward. Also, real estate market is such that the prices are not that volatile, unlike a stock wherein day and day down it goes up and down. But in a real estate, mainly it is almost a stable market and the fluctuations are very low. Also, I would say you should always evaluate the cost of capital, whether you break a PF, whether you get a loan from your company on a lower interest rate, all these things. You have to always compare the cost of capital. So the interest rate should be lower than your returns. So if you can ensure this, you will buy a property on a cheaper valuation, on a cheaper lending rates. So before buying a property, there are a few number of things you have to ensure. Already you know, but still, first thing you have to be very clear about is that you should trust your gut. So this is one main thing which you have to consider, because there will be a number of things which will be haunting you down, telling that you should not buy this property because of one reason, two reason, three reason, four reason. So you should first trust your gut and you should go ahead with that decision once you have done that. Definitely you have to do your research, just like before picking a stock, you do due diligence, you do n number of analysis. You also have to do such a research for buying such a big ticket item. You have to go through the reviews of the builder from various platforms or from people who have already lived in their properties. Site visit is very important. I suggest at least 50 times site visit to know what is the actual project, what are the intricacies in that project, what are the legal terms in that project, who means people, who is the landowner, whether it is a JV project. If it is a JV project, joint venture project, then what is the terms between the builder and the landowner. So how many flats are allocated to the landowner, how many flats is for the builder, how much money he has paid before getting into this deal, all these things. Also, I suggest you to discuss with the engineering guy, probably the civil guy or the architectural guy of that property, not just marketing. So marketing guys always tells the cream of the project, but the reality you will come to know only if you discuss with the engineer who is building that project. So you have to uh, take out ways and means by which you can have a meeting with that engineer and get personal with him and discuss what are the intricacies of that project. You have to compare deals of various properties and decide which one is good for you. You definitely have to clear all the doubts. Don't bother pinging the builder or the landowner, or in that case the advocate, whoever it may be, and get all the points cleared, only after which you have to invest, because it's a huge sum of money you are investing in that property. So getting clear on all the points, though the builder or the landowner gets irritated, is not our concern, but definitely you have to clear all the doubts. Real estate is such an investment wherein you have to worry about the micro market, the areas which is nearby your property, not the macro market, because mainly the real estate, the valuation of that property is mainly decided based on the nearby properties or nearby things which is developing in that area. And also definitely you have to go with the legal things, like if is there any dumping yard or any waste management zones coming near to that property. So this is a big red flag. Also, you have to ensure that the EMI which you are availing on a bank loan for this property has to be less than or equal to 30% of your total income, inclusive of your salary, dividends, or other rental incomes. RERA has done a beautiful work wherein they have told all the builders mandatorily to upload all the documents related to the legality and other clearances in their website. So you have that RERA number, type it in the Google, go to the site, download all the documents, go through all the documents, including the sale deeds and the agreements. So you have to go through each and every word and understand what are the intricacies or any problems associated with that. Another thing, you have to evaluate the rental yield if you are giving that flat on rent on a later date. So you can visit the nearby places and understand what is the current rental yield. Also, you have to keep on visiting that area, say during day, evening, afternoon, weekends, etc., to understand what is the mob in that area, what is the sunlight coming to that area, what is the wind, what is the dust, what is the future prospects of that area. All these things you have to get a good feel. So this really you have to allocate time, but understand the area before investing into that property. Real estate only pays off if you see in an actual way, if you are able to rent it out and get a good cash flow or a good rental yield which ensures a good cash flow. You will have to spend on the maintenance of the property. You will have issues regarding the new tenant because the old tenant leaves because of some reason, or then finding a new tenant is an issue. So all these things you have to somehow manage. Maybe you appoint a broker or a manager, property manager, so that he will take care of all these things, so that your cash flow is constantly ensured. But if you see a direct real estate property which is a flat or a livable area, the rental yield is always not more than 4% if you see. So if you see the yield, then crowdfunding or REITs are much better as far as the rental yields are concerned. Yes, if you are buying an undervalued property, then the property appreciation, if it is exponential, then definitely you have to consider that. But if that is not the case, and if you are buying it at a completely mature market, then the rental yield is the only thing which is saving you. And if it is less than 4%, then it is not at all comparable to REIT or the crowd-funded commercial properties. So it is better if you already have a flat, then investing in another rental property is not advisable. It is better you go with crowdfunding or REIT, or maybe go with another commercial property. So how to calculate the rental yield? I have mentioned that on the screen. So in addition to the rental yield in the equation, I have introduced maintenance of the property as well. So this, if you introduce, then only effectively you are getting a rental yield percentage, which is even less than what you have expected. So coming back to the crowdfunding properties, so commercial properties are one important real estate asset which you have to consider while investing into real estate. So crowdfunding is best for such a property because, as I told, it go for big ticket items or properties, and it is split into various investors, and 25 lakhs being the minimum investment. So this gives a good rental yield and also a good property appreciation as well. So there are various crowdfunding platforms like Strata, Property Share, Grip Investment, etc. So this actually ensures a monthly yield or a rental income directly into your bank account, unlike a REIT wherein it is paid out on a quarterly basis, and unlike a stock dividend which is paid out on a quarterly or yearly basis. So this plan is much attractive than a systematic withdrawal plan using a mutual fund. Normally in a crowdfunding, the holding period tends to be 2 to 6 years, because they say that if you are holding it beyond 3 years, then only the actual yield or the property appreciation is factored in and you get a good yield out of it in addition to the rental yield. So in a rental yield, it is split into two things. One is the yield from the rental income subtracting the management fee of around 1%. In addition to that, you have this tenant who is to whom we have leased this property. So they have some security deposit. So that deposit is put into a bank, and the interest rate from that bank also becomes the part of the rental yield to the person who is investing in the crowdfunding platform. So unlike a REIT, in a crowdfunding platform, you get more ownership of a particular property, unlike owning the company which is investing in lots of properties in REITs. So this is what guys I have to tell about the investment in real estate. So you have to do your thorough study. You should not be hesitant to ask questions to the builder while investing into the property. You should take their appointment, spend time. You should not invest in a haste. So just like stock investing, real estate investing is also one important platform which you have to explore. If you like the content of the video, please hit like button and subscribe to my channel. And also, if you have any doubts on this, you please feel free to comment on the comment box. And also, if you want more detailed video on real estate like crowdfunding, or particularly deep into the discussions like crowdfunding platforms like Strata, Property Share, etc., and if you want me to compare anything on such platforms, so you please comment me so that I can understand what is your requirements, and I will try to do that in the upcoming videos. Hope this session really helped you value add into your investing journey. See you in next video. Till then, happy investing.